All right, good afternoon, everyone. And thank you very much for joining me. Thanks again, Amelia. Terrible weather outside, so I commend everyone for showing up this afternoon and taking a bit of time out of your afternoon to learn a little bit more about the AlphaDEX methodology and what we believe to be the evolution of the exchange-traded fund marketplace. Now, just by a quick show of hands here, who is already familiar with First Trust, or who? Right, so you've heard of us before? Okay, great. For those who haven't heard about us, I'll do a quick overview of who we are as an organization, our methodology, our plans in the exchange-traded fund marketplace, and some of the products that we have here in Canada and also in the US. Now, as I mentioned at the beginning, I just said the evolution of the exchange-traded fund marketplace. Now, I started personally myself in the ETF space about 11 or 12 years ago. And when I first started in the ETF space, the market was very, very different. I spent most of my time just explaining to an advisor what an ETF really was. People generally didn't know what an ETF was. They compared and contrasted it to a mutual fund. Today, the marketplace is very, very different. And of course, almost everybody knows what an ETF is. And if I was to fast forward another 5 to 10 years, I would willing to predict that the ETF marketplace is going to look even more different. And the ETFs in the marketplace are going to look very closely to what we're doing currently right now. Now, when you think of an exchange-traded fund, you almost automatically think of passive management. Am I right? Right? So you think of an index return minus fees, and it's a relatively passive product. You're getting beta returns. Now, that's a little bit different than what we're doing, and in a sense that we are trying to generate alpha within an ETF structure. Right? So if you imagine investing in a low-cost, transparent, flexible structure such as an exchange-traded fund, but at the same time getting risk management and alpha potential as well. Kind of the best of both worlds, if you will. So if we're really where we compare ourselves to is a hybrid between a traditional exchange-traded fund, which you're all very well used to and know about, and traditional active management. So the AlphaDEX methodology blends the best of those two worlds and provides a very unique value proposition in the exchange-traded fund marketplace. Now let me just talk a little bit about who we are as an organization and talk about First Trust. So First Trust, we are a US-based asset management firm. We opened up our doors way back in 1991. We're located in a suburb out of Chicago. It's actually called Wheaton, Illinois. It's about 45 kilometers west of Chicago. We manage in excess of $90 billion. We have over 600 employees and a variety of different investment solutions that we provide north and south of the border. And also we're expanding in Europe as well. We are a privately owned company, and I call ourselves the silent success story. And the reason for that is that we are very successful. We have large assets. We're a fairly massive distribution team. However, most people, at least here in Canada, don't know who we are. And the reason for that is that the firm inherently doesn't do very much marketing or advertising. This is our parent company in the US. And the reason for that is that the money that we save on big billboards and TV ads and whatnot, we actually take that money and spend it on the advisor. Right? So it's a different way of doing business, if you will, but it's worked for us as an organization in the U.S. And this has contributed to the $90 billion of assets that we've accumulated over the 20-some-odd years. Now, in 2007, what we did is we entered into the ETF industry. Right? So we came into the marketplace 2007 with 16 AlphaDEX exchange-traded funds. So that was a good 7 or so years ago. Today, let's fast forward. We have over 85 exchange-traded funds. That's about $25 billion in ETF assets. But more importantly, we are one of the fastest-growing exchange-traded funds providers in the United States. So we came from somewhat humble beginnings to a serious player in the exchange-traded fund marketplace currently right now. What we're doing here in Canada as of last year is we're taking the success we've had in the US and we're bringing it to the Canadian marketplace. So you're going to hear a lot more about First Trust, the AlphaDEX methodology, and some more unique solutions that we're going to bring into the marketplace. So here's our growth rate, and Amelia started off with the growth of the ETF marketplace. We're no different, so we've grown substantially over the past 10 or so years as well. So we have about 22 or so compound annual growth rate since we opened up our doors many years ago. I find this slide here more compelling, right? So not only our growth rate as an organization, but our growth rate in the exchange-traded fund world. Right? So if you look over the past couple years, our growth trajectory has been phenomenal. We've way surpassed all the other ETF providers south of the border. Now, if you look at the ETF marketplace, there's 3 leading ETF providers. There's BlackRock, there's State Street, and there's Vanguard. They own about 85% of the ETF marketplace. There's about 40 other ETF providers that are fighting for the remaining 15%. We are one of them. Right? So we are currently ranked number 8. So we're the 8th largest ETF provider in the marketplace. But as I mentioned earlier, which is more important, we are the fastest growing. Right? So if you look at our growth trajectory, and this slide here ends in 2012, we added 2013, it'd be well off the page. Right? So that's pretty impressive. Right? I'll give you another stat, and this is another stat as of 2014. So let's look at the first quarter of 2014 in terms of asset flows in the United States going into exchange-traded funds. The leading provider in the ETF space was Vanguard. No surprise. So they brought in approximately $12 billion of net new exchange-traded fund assets in Q1 2014. The second one was iShares, or BlackRock. They brought in about $4.5 billion of net new assets. But really what is really impressive is the third ETF provider that brought in the third largest ETF flows was us. So we brought in $3.7 billion of net new assets in Q1 2014. Now, from a relatively small player in the ETF space, that's an impressive statistic. Right? I find that extremely expressive. There was actually an article that was written, and the whole premise of that article that came out about a month or so ago was, who are these First Trust guys and why have they grown so substantially? They almost brought in as much as BlackRock, who's the largest asset manager in the world. So what is going on here? Right? And the real answer is the alpha that we've been able to generate has certainly opened up the eyes of the marketplace south of the border. Advisors are willing to pay for alpha. We've been able to generate that alpha, and we're seeing increased success. What generally happens in the US, and I hate to admit this, but it generally happens in Canada as well. It just takes about 3 to 4 years to follow suit. So my job is to grow the ETF business here, to spread the good word of the AlphaDEX methodology, and to provide that solution to investment advisors and investors in general to the Canadian marketplace. All right, so let me get into the methodology of the AlphaDEX strategy. All right. So before I do so, let me just talk about the market cap weighted benchmark, or the S&P 500. So before I get right into the meat and potatoes, let's just take a step back and talk about where we came from. So everyone here is familiar with the S&P 500, I'm assuming, right? I'm assuming everyone else here is familiar with the SPDR in the US, right? Yes, no? All right, so the SPDR in the US, it's a product, one of the longest standing exchange-traded funds in the world. It's the largest ETF in the world for that matter. It provides exposure to the S&P 500. It owns all 500 securities, market cap weighted. You get this all for 9 basis points. You own the good, the bad, the ugly, all in one basket. All right? So let's take the S&P 500. Let's go back 10 years. And what we're doing here with this particular slide is we're taking all 500 securities and breaking up into 10 deciles, so 50 securities each. And we've broken up into the largest all the way down to the smallest companies. Right? So the smallest companies being on the far left and the largest companies being on the far right. And we've tracked their performance going back historically. And what we've noticed is that the largest companies on the far right didn't necessarily generate the highest rates of return historically. As a matter of fact, the smallest companies actually generated the higher rates of returns, and everything in between is a bit of a mishmash. Right? So what does that tell us? That tells us that by investing in the S&P 500, which is market cap weighted, so you're overweighting those larger securities, isn't necessarily the best way to invest in the large cap US marketplace. Those larger securities, which you're biased towards, haven't generated the best rates of return. Right? So you see that you have an orange line that goes across. What that represents is the weight of the S&P 500 in those particular deciles. So I'll bring your attention to the far right. What you'll notice is that the largest decile, or the securities that have the largest weightings of the largest securities, that represents about 50% of the S&P 500. So whether you like it or not, you're investing in the largest companies, which generally haven't been the best performing companies. So with our AlphaDEX methodology, we want to exploit this, and we believe that there's a better way to invest. Right? So not necessarily investing in the largest companies, but investing in the better companies based on the investment merits of these particular companies. So let me take that point and go a little bit further. All right? So going back the past couple of years, I'll bring your attention to 2011. On the far left, what we have is the largest companies. Now, the largest companies represented a return, the top 25 largest companies in 2011 represented a return of 2.6%. However, they represented 35% of the S&P 5. Right? However, if you look at the best 25 performing companies, they generated return of 52 or 53%, but that only represented about 4% of the S&P 500. Now, does that make sense? Right? So the best companies in the S&P 500 have a very, very small weight, and the largest companies have a very large weight. Right? So that's a bit of a flaw, and that's a flaw that we want to exploit, as I mentioned, within our AlphaDEX methodology. Now, that flaw is further reiterated if you look at last year. So last year, let's have a look at that same chart. I'll bring your attention to the far right, where you're looking at the best 25 companies in the S&P 500 generated return of 122%. However, that represents less than 2.5% of the S&P 5. Right? So how can we take advantage of this massive potential? And one of those solutions are factor-based or different types of methodologies outside market cap-weighted indices, such as the AlphaDEX methodology. All right? So let's talk about the evolution of the ETF marketplace. All right? So if you go back into the 90s when the SPDR, or the S&P 500, was first launched into the marketplace in 1993, right? So if you talk to Americans, they're going to tell you that the S&P 500, or the SPDR, was the first ETF launched in the marketplace. They're actually incorrect. So as Canadians here, we can be proud to say that we here in Canada have launched the first exchange-traded fund in the entire world. That was the TIPS and HIPS that merged together in 1990. Right? So be a proud Canadian that is actually us here north of the border. However, in 1990s, if you thought of an exchange-traded funds, they were generally market cap-weighted products, just passive vehicles that provide you exposure to beta minus fees. I call that the first generation of exchange-traded funds. Now, you went into the 2000s. Other players came into the marketplace, such as Claymore, all right, so that were subsequently purchased by BlackRock. They came into the marketplace with a different methodology, partnering with RAFI. So the research affiliates fundamental indexing that basically took market cap weighted benchmarks and they did something outside of beta, right? So people call it smart beta, fundamental indexing, whatever you want to call it. Really what it is something outside of traditional beta, right? Now, if you look into the future, and I call ourselves, the future of exchange-traded funds, I call this the AlphaDEX methodology, the third generation of the ETF marketplace, in which case what we're attempting to do is generate pure alpha within an ETF structure. Right? And I'll walk you through how we go ahead and do that. But as any product out there or any type of investment vehicles, there's always generations. Think of it as the iPad. Right? So it was the first generation, which was cool and great, and it did what it served you to do. But of course, there's evolution. Then there's a second version, a third version, and there'll probably be 10 versions. And the next one's going to be better than the previous one. All right, so what the AlphaDEX methodology attempts to do is blend the best of both worlds, as I mentioned a little while ago. So you have traditional passive beta-only exchange-traded funds in the marketplace, and then you have active management, so those SMAs, those mutual funds, or just plain active managers that are out there. What we're doing is we're blending the best of both worlds. We're combining those two together. As I mentioned, I kind of call it having your cake and eating it too. So you're getting both. So here's the meat and potatoes of the strategy, and I'll walk you through this strategy, and I'll go relatively slowly. Please ask questions if you have any. So we start with a broad-based benchmark, and our goal is to run a bunch of filters in order to generate alpha. Right? So I've been talking about the SPDR, so I'll continue with that example. So let's start with the S&P 500. We have an equivalent to the S&P 500 trading in the United States. The ticker symbol is FEX. Right, so we're essentially taking the S&P 500, and what we'll do is step number one is we'll break up the securities into growth stocks and value stocks. If a stock is deemed to be growth-oriented, then we're going to run three factors. The first factor is price momentum, second factor is sales growth, and the third factor is price to sales. Now, if a security is deemed to be value-oriented, we're going to run another three factors. That's price to book, price to cash flow, and then return on assets. And there's a very specific reason why we're going to use these six factors, and it goes back 60 years of research, primarily through the CIMA French model. Is anyone here familiar with CIMA French? right? So if you're not familiar with FAM or French, I just urge you to pick up a financial textbooks, and you'll see them written all over, right? So they're from the University of Chicago, and they're academics in the finance space. And it's basically taking their research and embellishing upon it and employing it into our AlphaDEX methodology. Now let me go into a little bit more detail here. So if you look at the growth factor, we're looking at price momentum, which is the leading driver in our growth model. We're looking at 3, 6, and 12-month price momentum. We're also looking at sales growth as well. Right? So we want to make sure that these companies are generating sales at the same time. So they're not just moving up for indiscriminate reason, that they're actually generating sales. So top-line sales growth. The third factor is price to sales. Now, if you look at price to sales, you may argue that that may look like a value factor. But the reason why we've added price to sales is that we want to make sure that we're not overpaying for these securities that are running up. So it's a bit of a value check, if you will. Okay? So if you look at our value metrics, pretty straightforward. So you're looking at price to book, price to cash flow, which are pretty traditional value metrics. But we added another one there as well, which is return on assets. And the reason why we added that is we wanted to make sure that all these securities are not reasonably priced because they're crappy companies. We want to make sure that you're actually getting a return on these companies as well, and there's future growth potential included in there as well. Okay? So every single security is going to get a score, right? In the example that I'm giving you, it's the S&P 500. All 500 securities get a score. We will then list them from the highest ranking security all the way down to the lowest ranking security. So what we have here is a very different list than what you're probably used to by looking at the S&P 500, weighted differently, weighted based on investment merit, not based on size. We could care less how big the company is. We're analyzing the company based on investment merit. Then we're going to do something very different compared to other ETFs, if this isn't different enough, and that is we're going to eliminate the bottom quarter of the portfolio. So you'll see a different color shaded box there at the bottom 25 securities. So in the case of the S&P 500, that's 125 securities. We're going to eliminate them altogether. And the reason why we're doing that is that we believe that generating alpha is not always about what you own, but it's also about what you don't own as well. So if you can avoid those landmines or those poor performing securities, then that's going to contribute to alpha generation just the same. And that's very different compared to other ETFs in the marketplace. All right? Now, the last process of the AlphaDEX methodology is we're going to take the remaining 75% of the portfolio, and then we're going to break them up into 5 quintiles. Each quintile has a very specific weight. You can see the weight on the screen behind me here. And essentially by those weights, we're overweighting the higher ranking securities, we're underweighting the lower ranking securities, and of course we've already eliminated the poorest ranking securities. This is what we call AlphaDEX. It's proprietary, it's trademark, it is our strategy. No one else can do it because it's patented. In addition to that, it's rigorous, it's disciplined, there's no subjectivity whatsoever, and as I call it, it's portfolio management without the portfolio manager, if you will. Right? Most portfolio managers are going to look at these various different factors just the same, but they're going to add fear, greed, emotion to the equation, and generally speaking, that's what ends up getting them into some trouble. We take that subjectivity right out of the equation, and we just run it based on the numbers. And then we rebalance it either on a quarterly or semi-annual basis. Okay? That is what we call AlphaDEX, and that has been what has been so successful in the United States. In 2007, we launched the original 16 exchange-traded funds, and I'll give you a stat here. Out of the original 16 exchange-traded funds that followed this AlphaDEX methodology back in 2007, 15 out of the 16 have outperformed their benchmark. Average level of alpha, so that's return over and beyond the traditional benchmark that it's tracking, has been approximately 4% net of fees. Right? So that's pretty impressive. There are some that have double-digit returns over and beyond the benchmark, but the average is about 4%. Right? There was only one fund that actually underperformed, and it underperformed by a mere 5 basis points. So let's call that one even. Right? So overall, it seems to be a strategy that works, and it seems to work over time. Now, I'm not going to stand here to profess to say that this is a strategy that's going to work every single month, every single quarter, every single year, because it's not. Right? Every quant strategy has its day in the sun. So it's not a strategy that works every time. It is a strategy, however, that's been proven to work over time. Right? So the longer you hold it, the better off the returns seem to be. Right? So definitely a long-term strategy, definitely not a short-term trading vehicle. Right? So keep that in mind. Okay? Now, let me get into some of the factors in a little bit more detail here and why we selected those factors. I mentioned it's based on the research from FAMA French, and it goes back 60 some odd years, right? So if you look at the top, so the blue and the red bars there, so what we're looking at are price to book and price to cash flow. So what we did is we took the S&P 500, we went back 60 years and we pulled up some data. So we took the S&P 500 and we broke up those securities in the S&P 500 into 10 deciles, broken up by lowest price to book and highest price to book, lowest price to cash flow and highest price to cash flow. And what we've noticed going back 60 years is that the lower price to book and the lower price to cash flow, you see there on the far right, generated the highest rates of return going back 60 some odd years, right? And what is even more important to that is that you can see an almost straight linear line going downwards, right? So the lower price to book, generally speaking, the higher rates of return that's been generated over 60 years. So that's kind of the premise behind the value factors that we have within the AlphaDEX methodology. Okay? The biggest driver in the growth factor is price momentum, as I mentioned to you. So it's 3, 6, and 12-month price momentum. This is a 12-month price momentum chart. We did the exact same thing. We took the S&P 500, went back 60 years. We broke up those securities into 10 deciles, broken up by their price momentum historically. And what we found is that the higher the price momentum generally means the higher the returns going forward into the future, right? And that's, as I mentioned, as you can see there, it's a pretty straight linear line. So for a quant shop such as First Trust, you certainly can't argue with the numbers. The stats are kind of hit you right in the face. Okay. All right. So what we've done now is in the U.S., as I mentioned, in the U.S. we brought in a variety of different products. We have 85 different exchange-traded funds. Half of them follow this methodology. So we're not exclusively about AlphaDEX per se. So out of the 85 or so exchange-traded funds that we have traded south of the border, half of them, 39 to be exact, follow this strategy. And they're broken up by sectors, style and sizes, and then countries and regions. Right? So whatever you're looking for, we probably have something that follows this methodology. The other 40 or 45 exchange-traded funds that we have south of the border are more index-based, more traditional, if you will, but the asset classes are much more esoteric. Right? So they're a little bit more niche-oriented, such as clean energy, IPO index, biotech, internet, technology. So very, very specific type of products. On your way out, there's a product list there on that table there. So if you want to grab one on your way out, feel free to go ahead and do so, just to get a broader understanding of the products that we have in the States. Here in Canada, what we did is we came into the marketplace. We currently have 5 products here in Canada traded on the Toronto Stock Exchange. 4 of them follow the AlphaDEX methodology. Now, I'll give you a quick synopsis of those 4 that we brought into the Canadian marketplace. Our foray into the marketplace was May 15, 2013, so we're coming close to our one-year mark. We're pretty excited by that. And we came into the marketplace with exposure to Canada, US, and emerging markets, all following the AlphaDEX methodology. Right. So the first one, as you see there on the screen, is FDY. That's the ticker symbol that provides exposure to the Canadian marketplace with a dividend screen and follows the AlphaDEX methodology. So it's risk management and alpha seeking potential as well. The fees, 60 basis points. It's about 50 or 60 securities held within the fund, so it's a fairly concentrated portfolio. Every single security pays a distribution, and again, the whole premise behind the strategy is to reweight the securities based on the AlphaDEX methodology to generate alpha. Distributions are paid on a monthly basis, and we're very pleased with this particular product since it's been used as a replacement for traditional active management. I see advisors using this for tax-free savings accounts, RESPs, or just, for example, smaller accounts where they can't build a traditional stock portfolio, and also a complement to traditional ETFs or Canadian equity dividend type ETFs that are already on the marketplace. Second one is FUD, or FUD as I call it, and that provides exposure to the US marketplace, again, following the AlphaDEX methodology. So the way we've structured this particular fund is we take the S&P 500, similar to FEX, like I mentioned in the US. However, we employ a dividend screen, then we apply the AlphaDEX methodology, again, 60 basis points as well. Currency hedged, which is another feature that we've added to this particular product as well, and distributions paid on a monthly basis. Right. And as I mentioned, the inception date was May 15th, and we're going to be pretty excited. But according to this fund, according to the numbers that we've seen, FUD has outperformed the S&P 500 by approximately 600 basis points since we launched it. Right? So we can't post that yet. So close to when we actually launch it, we're certainly going to be letting people know that the strategy has been working well. Now, the last one that we launched back in May 2013 was exposure to emerging markets. Right, and that's valuation-wise, it's kind of primed to look at emerging markets. I see people that have kind of shunned emerging markets over the past couple of years are looking at EM currently right now. So again, very similar strategy. It's pretty consistent. We started with the emerging markets. We screen for dividends. We then take that subset, employ the AlphaDEX methodology. We employ a currency hedge on top of that as well, 65 basis points, distributions paid on a monthly basis, and again, alpha seeking potential in order to get exposure to the emerging markets. Okay. A couple of things worth noting is that for all these funds that I mentioned, there's 2 series of each fund. Right? So there's the regular series, and FDE is the ticker symbol, but there's FDE.A. For those advisors who are non-fee based, that might be applicable because it actually pays a 1% trailer. Right? So again, the choice is yours. Okay. And the last one that we brought into the marketplace was fairly recent. We brought that into the marketplace February 2014, and we were proud to be Canada's first exchange-traded fund in Canada to provide exclusive exposure to the European marketplace. Again, it's following the AlphaDEX methodology, screen for dividends, and then we employ the screening process of AlphaDEX. Distributions paid, again, on a monthly basis. Currently, it's around 2% and change, and again, currency hedged as well. Unique thing about this particular fund is that it provides exposure to all of Europe. So it's not countries that are part of the Eurozone. It includes countries outside the Euro, such as Switzerland and the UK as well. So it's all encompassing. We have an equivalent product in the US that employs the AlphaDEX methodology that provides exposure to Europe. The ticker symbol there is FEP, and trades in US dollars. And that particular fund has knocked the lights out, quite frankly, in 2013. We outperformed our respective benchmark, which is MSCI Europe, by 6.5% in 2013. Now, of course, it's a different product. It's in US dollars versus the Canadian one. But in terms of a proxy, that might be a general gauge of whether or not the strategy seems to work or not. Okay. So that is AlphaDEX. I thank you all for taking a bit of time learning about First Trust, learning about the evolution of the exchange-traded fund marketplace, and more specifically, learning about the methodology that we employ and we are quite frankly quite excited about to bring into the marketplace. You're going to hear more about AlphaDEX. You're going to see more products coming into the marketplace that follow this same strategy, different geographical regions, potentially different sectors as well, and also different products that are non-AlphaDEX oriented as well. Ironically, our most successful product since we came into the marketplace is actually our senior loan product, which is a different topic than the AlphaDEX. But essentially, I mean, that's about 60-some-odd% of our assets is in a senior loan, actively managed product here in Canada. I'll welcome you all to grab our US product sheet because it's a much more encompassing list as well. I'll also introduce you to Canis, who's standing in the back. She works with me here, so we are responsible for providing service and support to investment advisors in the Toronto area. And have a great day and try to stay dry. Thank you.